It's tax season, finally. For many people, it's the one time a year when they actually look forward to dealing with the IRS because they're getting a refund. That refund can feel like a bonus or a reward. But here's the truth, it's not free money. Welcome back to my channel. If you're new here, I'm Joe, a licensed certified public accountant with over 10 years' experience in corporate and public accounting. I have an extensive background in accounting, audits, and taxes, and I'm all about helping you take control of your money and live smarter. Be sure to subscribe to the YouTube channel and turn on all notifications. And check out our blog site where we post every Monday, Wednesday, and Friday. In this video, we'll break down how tax refunds really work in simple, everyday language so you'll understand what exactly is happening and when you get that refund check. Let's jump in. A tax refund is what happens when you pay more in taxes during the year than you actually owe. Every time you get paid, your employer withholds a certain amount for taxes, based on the information you gave them on your W-4 form. At the end of the year, when you file your taxes, the IRS compares what you paid with what you actually owe. If you pay too much, that's when it triggers a refund. If you didn't pay enough, that's what triggers the amount that you owe. So that refund check, it's just your own money coming back to you. There's a few common reasons why you would get a refund. The first common reason is too much was withheld from your paycheck during the year. If your employer held back more than what you actually owed, you'll get that extra back. A second common reason is you qualify for tax credits. Some tax credits directly reduce the amount of taxes you owe, and some are refundable, meaning you can get money back even if you don't owe taxes. Example, include the child tax credit and the earned income tax credit. The third common reason is you have tax deductions. Deductions like student loan interest, mortgage interest, or retirement contributions can help to lower your taxable income, which might lead to a refund. Okay, let's look at an example. Let's say, for example, and remember, all these numbers are made up. Let's say you made $50,000 this year. Based on that income, you actually owe about $4,500 in federal taxes. But over the course of the year, your employer withheld $5,500 from your paycheck instead. That means that you overpaid by $1,000. So the IRS gives that back as a $1,000 refund. Can you see it? It's not a gift. It's just your money being returned. Getting a big refund feels great, but it's not always the smart financial move. Why isn't getting a big refund always the smartest financial move? Because it means you're overspending your tax dollars all year. Basically, you're giving the government a free loan, and they're just paying you back now without interest. If you regularly get a big refund, consider adjusting your paycheck withholdings. You could be using that extra money every month to pay off debt, build your savings, or invest in other things, instead of waiting until next tax season. It's like my old college professor used to tell us all the time in my tax class. Shout out to Professor Graber. Uh, Why would I want to give the government free money when they're just going to turn around and give you and charge you interest if you owe them money? So you might be asking yourself, how do I strike that balance between not owing too much, but also not getting this large refund you're talking about? Here's 3 ways to strike that balance. Number one is check your withholdings. The IRS has a free tax withholding estimator on their website. You can use it to see if you're paying the right amount. Number two, you probably need to update your W-4 form when your life changes. If you've gotten married, had a kid, or started a side business, all of these affect how much taxes you owe. And finally, number three, keep good records. Track your income, expenses, and deductions, especially if you're self employed. That helps you to file accurately and avoid surprises at the end of the year. Ideally, you want to plan as close to zero as you can. A small refund or owing a small amount isn't too bad. This means that you've been estimating your taxes pretty accurately throughout the year. A small refund equals your money stayed with you, working for you, instead of sitting with the IRS. So remember, a tax refund isn't an award. It's a refund of your own money. Understanding how it works helps you to take control of your finances, plan ahead, and use your money smarter all year long. If this video helped you understand tax refunds better, hit that like and subscribe button and share and check out other videos on simple everyday money tips. Because managing money doesn't have to be complicated. It just takes a little bit of understanding.